Who don't know, my name is Joe Rokop, Managing Director of Commodities and Equities. Today is Monday, October 10th, 2020, times 4 p.m. Central. So, first of all, thank you thank you to everyone for being here, and welcome as always. State of the market is undeniably volatile and undeniably bullish. Let's talk about what we've seen today and over the course of the last two trading days, Friday and Monday. And then I will also talk a bit about some of the factors driving the market, a little bit of history of the potential downfalls or uprises of the market in the face of presidential health and presidential uncertainty. And then we'll talk a little bit about crude oil as well, and discuss where that is and where it's going. So without further ado, let's talk about today. So right now in front of you, the chart you see is the S&P 500, and it is the futures chart. So all of the levels you see here are going to be for the ES December 20 contract. Now the levels are very similar to the. Oh, hold on one sec, folks. Looks like we're having a bit of a technical issue here, so I ask that you be patient while we get this fixed on the back end. Our apologies. So, on the day, the Dow has came up nearly 500 points. Let's take a look at that. With our low of the day basically from the open, was our low of the day down here at 27,650. You can see the market gapped open to begin the day. Here at 27,650. Made a quick pop up, little retrace, and then was off to the races. So again, folks, this is, for those of you just joining us, this is the YM, or the Dow futures, okay, similar to the Dow Jones Industrial Average. The difference between futures and index is simply a cash versus indice price, which you can go ahead and take a look at that spread on any of your quote boards. But for the sake of simplicity, I am going to be using futures prices during today's sessions, just to make sure we're doing apples to apples. So let's kind of circle back to where we started. All right, so on Friday last week, and I'll show up the ES for this. On Friday last week, stocks took a bit of a tumble, falling early in the day, with the Dow down more than 400 points at its session low, and that was, of course, due to the Trump tweet that he had tested positive for COVID-19. Equities ended Friday's session with a loss, but they were off the day's lows. The S&P was down just 1%, and the Dow was down 0.5%. Okay, so it was very positive that the break we saw last week, specifically last Friday, when that news came out, was limited, right? And if you take a look at this candle right here, when the news was released, and this was Thursday evening, okay, the ES or the S&P 500 future was trading 33.64, and that dropped all the way down to 3,300. So a 65-point drop in less than an hour. And that is a massive, massive move for the S&P 500. And when I say massive, I suppose I mean a massive move within such a short time frame. You generally will not see a range of the S&P of greater than 50 points in any given day. On average, it'll be less than 35 points, give or take. And to see a 65-point range in simply an hour is a really, really big move that should be eye-opening and concerning for most. However, as the clock turned into Friday, you can see that the market is slowly rising back up, rising back up, rising back up. And then by the close, we were all the way back at approximately 3,350. Okay. So the 65-point drop after the release of that news was nearly completely closed. Okay. So that gave us pause coming into today, especially into last night, with respect to what the news over the weekend was going to be with respect to President Trump's health and how said news was going to affect the market. Now, it should be noted that the the numbers that were produced in those moves were somewhat unusual. Again, as I mentioned, with the degree of the moves. But let's take a look here at what happened on Monday night, or on Sunday night into Monday morning. And you can see here where the S&P finished at approximately 33.48. The market gapped open about 10 points up to near 33.60. Okay. So why did it do that? So the doctors and White House staff offered kind of conflicting assessments about Trump's condition over the weekend. But on Sunday, said the president had seen improvement. Okay. And then today, President Trump briefly left Walter Reed Medical Center and did a drive-by and wave at supporters gathering outside of the hospital. So the market proceeded to rise sharply on today's Monday session, and that was essentially an inverse response to the uncertainties about the president's condition, which of course were delivered late Thursday night. And then as the markets were bounding higher today, going into the close over here on the right side of my screen, the markets continued to break out and make new highs, and that is after President Donald Trump indicated via Twitter that he was healthy enough to be discharged from Walter Reed and would be continuing his care and recovery at the White House. So what does that mean for the future? Well, I think one of the takeaways from this particular event is that the market is without a doubt a barometer of economics and not politics. Okay, history shows that the stock market's rebound after following faltering late last week is not out of the ordinary, as a matter of fact. If you look back approximately 100 years, it shows investors have usually been pretty quick to shrug off bouts of even serious illnesses and deaths when it comes to U.S. presidents. So I've pulled up a chart here for you folks that you can take a peek at. The deaths of Presidents Harding, Roosevelt, and Kennedy, along with many other presidential medical surprises, resulted in declines of 3% or less for the Dow Jones Industrial Average, and those lasted only a few days. Only Dwight Eisenhower's heart attack in 1955 and a diagnosis of Crohn's disease in 1956 were greeted by declines in excess of 5% that lasted multiple months. So, if you look on the chart here, you can see President Wilson was infected with the Spanish flu in April of 1919. Dow Jones dropped 1.5%. It took 4 days to recover. Interesting that that's the first one listed on this chart, as the Spanish flu is most comparable to the coronavirus in terms of presidential illnesses or medical conditions. Looking down the list, the largest market mover was Eisenhower's heart attack in 55, as mentioned, and that was 10%, taking 75 days to recover. And then Eisenhower's Crohn's disease, which happened May 10th of 1956, saw a decrease of 6.5%. Now, what's most noticeable on this chart is if you look at Ronald Reagan getting shot. Market was down 0.3%. Okay. Reagan prostate cancer didn't move. And some of, Harding's death down 1.1%. Now, it's certainly, without a doubt, a cause of uncertainty, right? And a factor of fear that will be placed into the market. However, with a strong economy, we are looking at a larger snippet of history, right? That's not only applied to the presidential office, as the market is composed of so many factors that are not simply limited to the president. Okay, so while it certainly needs to be taken into consideration, it need not be the only variable that you look at. Okay, so what factors are driving the market? And we'll take a look at the NQ now, and I'll go ahead and post that. The NQ took a big rally today as well, up 3.3%, or excuse me, 2.32%. You can see here the market gapped open on Sunday night along with the ES and the YM, or the S&P and the Dow. NASDAQ moving up to a level of 11,500, just shy. Going forward, that's a very important level for us to keep an eye on, as I believe that can be a pivot point. If the market is able to rally up through this 11,500 level, I think we can make another run at the 12,000 level. Now, this is a daily chart going back until September 25th. And you can see the swing highs here just around this 11,500 level. We did a bit of a head fake up here, but that sold off going into Friday's trading session when the presidential news was let out. Thus, one could say that now that this recovery of the market since the news has been nearly completed, if we are able to fully complete said recovery, then 12,000 or even 12,500 is in the picture. Okay. So what's driving the market right now, I think, is really the main question, as state of the market. So obviously the apparent improvement in President Trump's condition diminishes one element of fear and uncertainty for investors. Okay, that's factor number one. Factor number two, worsening poll numbers for the president's race against his Democratic challenger, Mr. Joe Biden, are seen potentially boosting the odds that the White House and congressional Republicans will be eager to come to a deal with congressional Democrats on another round of coronavirus aid, i.e., the move higher in value stocks like financials and lots of banks was also supported by increasing hopes that the U.S. Treasury Secretary and House Speaker Nancy Pelosi will be able to progress their weekend talks to a deal. So this last weekend, there were talks of a continuing aid package that had been stalled from a few weeks prior, but those talks were continued this weekend, and hopes that a deal would be struck have risen. Now, if we do have yet another aid package, that will, of course, send the markets higher. To piggyback off of the increase in former Vice President Joe Biden's polls, as discussed in the previous factor, the third factor adding some oomph to this rally would be that as the polls increase, or as the poll differential increases, the proposition of a contested election will decrease, i.e., if Joe Biden beats President Trump by the projected numbers, then it's less likely that the election will be contested due to the fact that the gap between President A or contestant A versus contestant B will be wider, right? Now, if the gap is very slim, you can almost guarantee that this goes to court and could potentially go to court for a while, right? However, if the gap is large, then the probability of that is lower, and the length of that battle would theoretically be lower as well. Okay, so just to restate, as Joe Biden's lead in the polls increases, the probability of a contested election decreases, which is good for the market. Okay, and when I say good for the market, I guess more accurately stated, I would say is more bullish for the market, as good as a subjective term. Okay, and then there's also been news on successful coronavirus drugs. That has been hitting the tape quite a bit, and every time there is news on that front, especially positive news, we do see an increase or an uptick in market prices. So, if you go back to March and April, when the news about these potential life-saving drugs were being tweeted out, every time a tweet came out from the AP or there was a retweet from someone of importance, we saw significant market drops, very, very fast market drops. And the names of those drugs, the names of those individuals had already been pre-programmed into various algorithms. And so that's why we saw those massive swings the moment that news hit the tape. A little bit different now due to the fact that there is some more stability and confidence in these drugs. So we won't see as fast of a move as we saw 4 or 5 months ago, but we will see a sustainable uptick in positive news and a sustainable downtick in negative news. Okay. So I would say that the move we saw today is certainly an implicit bet that there will be massive fiscal stimulus spending coming out in the very near future. And I think that, again, the implicit bet is, in fact, a safe bet. Okay, so that's really the bare bones of what we are seeing at the moment, uh, and it's all related to really um, the election, but ultimately it's related to the stimulus package, right? So it depends on what viewpoint you want to take, chicken or the egg. But essentially, we're looking at the aid package, right? And what affects the aid package, the president's health, the presidential election, and of course, where the polls are now, where that stands. So the market is very actively pricing as much in as it possibly can. Okay. And with all of this activity and all of this volume and thus volatility, it gives us ample opportunity to enter and exit some pretty large trades. So what am I looking at in these types of trades? Well, quite clearly, and I would say quite concisely, I'm using the VWAP chart of mine to really establish some solid entry and exit levels. I'm coordinating that with the HVA chart you see over here on the right, and then using daily pivots, specifically high lows and POCs, to help identify areas of congestion where I can begin scaling out of my position, and areas of extension where I can close my position. Okay. Now let's talk a little bit about crude oil while we still have a moment here. I'll try and get some specific trade examples in before we're done. So crude oil rose quite a bit today, up 6%, and that is on a supply disruption due to a strike in Norway and also another tropical storm heading in through the Gulf of Mexico, Tropical Storm Delta. We have now moved on to the Greeks, which is a bit sad. For those of you who don't know, we go A to Z and then we go to Greeks if we run out of English alphabet letters, so that's why we're on Delta. A little piece of trivia for you. But anyways, so a strike is looming in the Norwegian oil and gas industry, as estimates say as much as 330,000 barrels a day. And that is equivalent to 8% of Norway's oil and gas production. It should also be noted that, well, let's compare 330,000 barrels per day. Is that a lot or is that a little? Well, I suppose if the market were balanced, it could be considered a moderate amount, but the market is imbalanced. And what does balanced versus imbalanced mean? A balanced market is when supply equals demand. Right now, the market is out of balance, and it has been for a few years now. Which way has it been out of balance? Well, we've had an oversupply or a glut of oil. So high supply and low demand, which is why the market has fallen. We look back to the beginning of the year when crude oil was up here at $65. Going into the coronavirus epidemic, crude was already on the downturn. You can already see the crude dropping. Then we can see the gap on the release, and down again, down again, down again, and then of course when crude went negative. So it's no surprise that crude oil has been dropping. In my opinion, it should actually be lower than it is right now. But I suppose the same could be said for all market sectors and stocks for that, and for many stocks for that matter as well. But to circle back to the question of how much is the offline production or the offline lack of production for Norway's 330,000 barrels per day going to combat the market, and the answer is very little. OPEC right now is reducing their production by millions of barrels per day. Millions of barrels per day. So zero point 0.3 million from Norway is going to be pretty small. Okay. So although when you read through all of your energy reports, trade journals, etc., most of this rally is going to be directly attributed to Tropical Storm Delta and the strike in Norway. In reality, in my opinion, it's really more of a recovery in prices tracking stocks. Okay, we have noticed when the stock market has had big pops, crude oil has followed it, although it has been lagging, of course, due to I would say which is clear as the various stock market sectors have made all-time highs, and then crude, of course, is still hanging out down here at the bottom of its yearly range. But it should be noted that, again, the reason it's down here is due to the oversupply and lagging demand. Okay, so the forecast of crude production here in the States that will be taken out of production is about 17%, and that is when Tropical Storm Delta is forecasted to move into the Gulf of Mexico. And again, the production levels of Gulf of Mexico versus the total U.S. production levels is about 17%. So if all of Gulf of Mexico goes offline, that's how much oil would go offline with it. Okay. Now, to come back to OPEC, the potential supply disruptions, as previously discussed, are weighed against further signs that some OPEC members, specifically Liberia, which are all part of the production cut accord, are in fact ramping up production and not adhering to their specified levels of production decreases. Thus, the quick takeaway is that the tropical storm and the strike in Norway can easily be shrugged off by other OPEC nations immediately turning on the spigots across the board. Okay. So to come back to, we only got a few minutes left here, but all in all, we are in a volatile bullish market. Volatility will increase significantly here over the course of the next 4-5 weeks, and then depending on the election results and potential court battles that ensue from that, we'll have some very large intraday moves. Okay, and essentially what I'm looking to do on an intraday basis is to buy pullbacks on top of rolling VWAPs that correlate with HVAs or high value areas, high volume areas, as you see here on the right, and look to reduce my position as the market runs. Okay. And one of the most important aspects of trading is anticipation, right? And so we want to get ahead of all of these moves and get these positions on prior to everyone in Robinhood buying something that's already high and already overbought. By the time the individuals in Robinhood are buying, that's when we want to begin selling. So with that, I will leave you with a wish of good fortune and good luck. Thanks for hanging out with me today. I hope you enjoyed the state of the market with myself, Joe Rokop, and I will see y'all later.